G'day everyone, and welcome to week 8 of our Legal Ethics and Trust Accounting course. For the past 3 weeks, our focus has been on the duties that a legal practitioner owes to the client. This week and next week we're continuing that theme, but with a little bit of a twist, as we focus on the responsibility that a legal practitioner has when they are handling the client's money. One of the basic principles that we learned about a few weeks ago is that legal practitioners and their clients are in a fiduciary relationship. A relationship where the fiduciary is placed in a position of utmost trust and where that trust must be discharged with absolute integrity. All of this is even more emphasised when we start to deal with the client's money. Imagine, for instance, you have a client making a major purchase and that your firm is the stakeholder for that purchase. You might be holding on to millions of dollars. Or imagine a large commercial client embarking on major litigation, placing say $100,000 into the kitty to cover future legal costs. Or imagine that you've had a great win and an insurer pays into your firm's account $500,000 to be paid to the client. None of this money belongs to the firm. It's other people's money. And in order for the profession to continue, we need to maintain a situation where nobody would have a moment's concern about the prospect of that money disappearing. It's money held on trust. Trust money. That's what we're learning about for the next couple of weeks. Now, traditionally, this has been taught by making undergraduate students do pen and paper, double ledger bookkeeping of pretend trust transactions. Those exercises are available to you. Some of you may be keen to do them, but I don't enforce them. One reason I don't enforce them is that the Priestley requirement for this subject is for you to understand the principles. It's not for you to become a member of the Pretend Junior Accountants Club. More importantly, none of you are going to get your hands on your firm's trust accounts for years. Even having an unrestricted practicing certificate is not usually practically going to let you operate a firm's trust accounts. Realistically, before you're operating a trust account, you're going to have a principals practicing certificate. And guess what takes a huge proportion of the principals practicing certificate course? You guessed it, trust accounting. So let's focus on the principles. We start with the basic fact, often ignored at law school, that every private firm is a business. Every law firm is governed by the unalterable mathematics that says money comes in and money goes out, and unless you make more money than you spend, the business will go bust. In the very first week of this course, I talked about the law as a profession committed to serving the public, and that is true. But it's also true that law firms are businesses, and their purpose is to make profit. Law firms obtain most of their income by way of fees. Clients are asked to pay fees for the work undertaken by the law firm. This simple fact causes a great deal of the public concern about the legal profession. There's no equivalent to Medicare or private health cover to pay legal bills. When a person needs a doctor, there's a system to manage the costs. When they need a lawyer, the bill is theirs alone. Public concerns about billing seem to fall into 3 categories. The fact that legal work is expensive, the fact that at the outset of a legal dispute, the client may have no idea of what they might end up spending and what they might get for that money, and the fact that the costs of being involved in a legal dispute are now such that for many normal people, justice is out of reach. Now, there's genuinely little that can be done about the cost of legal disputes. Operating a law firm is expensive. Office real estate is expensive. Practice management systems, insurance, compulsory professional development, these are all expensive. In addition, a partner level lawyer has done years of study. Very few just have an LLB, and they've developed years of experience. You can't expect to hire that for $100 an hour. Because legal services are expensive, there's also not a lot that can be done on the access to justice issue either. There's legal aid and community legal centres, but these are all pitifully underfunded. Most firms undertake at least some pro bono work, but there's little rhyme or reason about who gets access to those pro bono schemes. What policy can address, however, is the second concern, the notion that when commencing a matter, a person has no idea about what it's likely to cost and how those costs come to be. Part 3.4, Division 3 of the Legal Profession Act 2007 sets out standards for cost disclosure. In short, the requirement is that there must be a costs agreement in place before the law firm is entitled to charge anything at all. And that costs agreement must be supported by a disclosure notice, which sets out the way in which fees are charged and gives an estimate of what the overall likely costs are for each phase of the litigation going forwards. If those estimates then change, the firm is required to produce an updated estimate. The idea is that the client at all times should have a realistic understanding of what their future costs are likely to be. And then whenever a client is invoiced, the client should be able to obtain an itemised bill showing what work has been done and how that translated into fees. Most firms provide an itemised bill every month, just as a matter of course. So, how are fees calculated? The simplest method is to have a fixed fee. Many firms will have fixed fees for relatively simple, predictable transactional work. For instance, many firms will have a single price for the preparation of a simple will, or the preparation of a trust deed, or the conduct of a conveyance for a simple residential house sale. These are things that the firm does over and over again, and so the staff know the time required and the costs required, and they can make a solid estimate. Some firms are starting to extend fixed fees into more complicated areas of law, and personally I think it's a very interesting way to go if it can be made to work. If fixed fees are being used, then the costs agreement with the client can simply state that fixed fee. Simples. The second method for calculating fees is probably the most common, and that is time-based charging. Essentially, your firm decides what an hour of your time is worth and then divides that into 10. The client then gets charged one of those increments for every 6 minutes that you work on their file, or every part of 6 minutes. So let's say you're a junior solicitor and the client is being charged $120 an hour for your work. That means it costs the client $12 for every increment. So if you spend 8 minutes and 42 seconds writing an email, the client gets charged 2 increments, or $24. Obviously, time-based charging does make it difficult to predict what the client will be charged. Everything takes longer and costs more than you expect. But in the client agreement, your firm will be expected to give its best estimate as to the costs for each stage of the proceeding. And your firm will also be required to disclose the hourly rate for every person who's expected to work on the file. Some firms have a combination of fixed fee and time-based fees by using time-based fees but also setting a cap. So they might say, we'll charge time-based fees, but the maximum charge will be $10,000. That means that if $10,000 in fees have already been racked up, but there's more work to do, the firm's working for free. The third common option is really a creature of personal injury law. It can be used in any type of law. That's called a contingent fee arrangement. These are often advertised using the phrase no win, no fee. The idea here is that the client pays nothing up front. The firm keeps track of the time-based charges for the work done, and then when there's an award in favour of the client, the firm can take its fees from that award. Usually, the firm is allowed to mark up its fees by about 25% to take account of the risk that the client will lose and the firm might not get paid anything at all. That's a real risk. Also, the firm is usually limited so that the firm can only obtain a maximum of 50% of the net award made to the client. So a firm might do $30,000 of work for a client who settles for, say, $40,000. The firm is straight away out of pocket by $10,000. That's $10,000 worth of wages bill that's going to have to come from somewhere else. So Firms that operate on a contingency fee model have to be really careful in their selection of which matters they're going to take on. Finally, in addition to fees, there are what we call disbursements. These are things that the firm has to pay to third parties, and so the firm has to recover those from the client. These might be things like barristers' fees, court filing fees, fees for an expert witness to generate a report. These are not fees as such because the firm's just paying them on to someone else, but they do need to be accounted for. Usually the way all of this works is that the client is asked to pay an amount of money into trust. If it's a fixed fee arrangement, they'll pay the fixed fee into trust. If it's a time-based arrangement, they pay the estimated costs into trust or some other commercially agreed figure. If it's a contingency-based agreement, they might be asked to pay an amount into trust to cover disbursements. That money, when it goes into trust, still belongs to the client. It doesn't become the firm's money until the work is done and an invoice is rendered and the client agrees to the transfer of funds. We're going to talk a lot more about this in this week's and next week's videos. The final thing I want to raise in this video is that the Legal Profession Act, like all other similar legislation in other states, contains provisions for clients to challenge their legal bills and to have them independently assessed by a costs assessor. This means that every cent that a firm charges to the client, they must be able to explain how that charge came to be. In the second video this week, we're going to explore the idea of trust money more. We're going to do this in some detail because it's incredibly important that you understand these concepts. See you in video 2.